Hello class, and welcome to the video lecture for recording transactions for dividends, treasury stock, and retained earnings. The third learning unit is about journalizing the purchase and sale of treasury stock. Treasury stock is previously issued preferred or common stock that has been reacquired by the corporation. It accounts for the difference between issued and outstanding stock. Treasury stock has been issued, but because it's owned by the corporation, not the stockholders, it's not considered outstanding. Because the owner of treasury stock is the corporation, we don't use it in dividend calculations. When you calculate dividends, be sure to only use the amount of outstanding stock, not issued stock. It's important to keep track of treasury stock purchases in order to determine the number of shares of stock that are outstanding. Treasury stock is a general ledger account with a normal debit balance. It's a contra stockholders' equity account. When it's purchased, it's recorded at the purchase price. Let's look at the textbook example. On June 1st, Ashley Corporation has 5,000 shares of $10 par value common stock and 2,000 shares of preferred stock outstanding. The corporation purchases 1,000 shares of its own common stock at a price of $12 per share. We record the purchase with an increase in treasury stock, which is a debit, for the number of shares purchased times the price of the stock. Since the treasury stock was purchased for $12 each and 1,000 were purchased, the amount of the debit is $12,000. We credit cash to record the decrease in cash used to purchase the stock. Treasury stock can be reissued at a price above or below the cost the treasury stock was originally reacquired for. When it's reissued for more, we increase a paid-in capital account to record the amount above the original price. When it's reissued for less, we decrease the same paid-in capital account until it's used up. Once it's used up, we decrease retained earnings. Let's look at the example. Remember, Ashley Company had purchased 1,000 shares of treasury stock for $12 each. Now, on July 8th, the company reissues or sells 100 of those treasury stock shares for $15 each. If the company sells 100 shares for $15 each, it will receive that amount in cash, so we debit cash for $1,500. Now we reduce the treasury stock account. Remember, treasury stock was increased with a debit, so now we decrease it with a credit. The amount we decrease is the number of shares we're reissuing times the price we originally paid for those shares. The original price was $12 per share, so we credit $1,200. Since we're reissuing the stock for more than we originally paid for it, we credit the excess in paid-in capital from treasury stock account for $300. I'd like to finish this learning unit with an exercise from the textbook. So let's do exercise 19B-4 on page 705. It's up at the top, 19B-4. So it says we have common stock with par value of $8 per share. 79,000 shares are issued and outstanding. So journalize the following entries. April 3rd, we issued 5,500 shares at $12 per share. Okay, so April 3rd, we're going to debit cash for the amount of cash we're receiving, and that's going to be the number of shares times the price per share. So that's 5,500 times $12, which gives us $66,000. So we debit cash for $66,000. And then we credit common stock. And that's going to be the number of shares issued times the par value per share, which is 8. So that's 5,500 times 8, which equals $44,000. So we credit $44,000. And the rest goes in a paid-in capital in excess of par account, which we can abbreviate PIC, paid-in capital. The rest is $22,000. Okay, so on April 9th, we reacquired 205 of those shares at $10 per share. Okay, April 9th. So reacquiring shares means we oh, sorry, I'm not writing there very good. Please excuse that. Reacquiring shares means we have treasury stock. So we're going to debit treasury stock. And that's going to be for the amount that we paid of $10 times the number of shares. So that's 205 shares times $10 each, which works out to be $2,050. Okay, and then we pay for those with cash. So we credit cash for $2,050. Okay, now on April 15th, we reissued 110 shares of treasury stock at $11 per share. So we took 110 of those shares that we previously reacquired and we resold them. Okay, so this is April 15th. So what are we going to get when we resell them? Well, cash. And what are we reselling them for? $11. So 110 shares times 11 is $1,210. So that's how much cash we're receiving. So we debit cash. Okay, and then we're taking those out of treasury stock. So we reduce treasury stock with a with a credit. But for how much? How much is the amount that we originally paid for them, which was $10. If you look back on April 9th, we paid $10 for those. So 110 shares at $10 each is $1,100. Okay, now we have a difference here. So we reissued them for more than we originally paid for them. So we have a paid-in capital account just for treasury stock. I'm just going to abbreviate that here. Paid-in capital from treasury stock, which is where we put the difference. And the difference is $110. So that's our journal entry for April 15th. Okay, now I'm going to make some room here for the last one. On April 17th, we reissued 46 shares of treasury stock at $5 per share. Okay, so April 17th. So we have some cash here, 46 shares times $5 per share is $230. Okay, and I'm going to leave a little bit of room here and jump to the credit to treasury stock. So we want to reduce our treasury stock account for the 46 shares, and remember we paid for them, it was $10 per share, right? So 46 times 10 is 460. Okay, and now we're reissuing them for less than we paid for them. So this is kind of a two-step process. The first step, I'm going to make a T account over here for my paid in capital treasury stock account that I created on April 15th, and I put this $110 in there. So it's kind of like having a little bank. So the first thing we do is we reduce that to 0, and we reduce a paid in capital account with a debit. Okay, $110. So we've just zeroed that out. But is that enough to make up the difference? No, it's not. So the next thing that you do to make up the difference is you take it from retained earnings. And a reduction in retained earnings is done with the debit, but for how much? Well, it's going to be the difference between your total credits and your total debits. So 460 minus 230 minus 110, and that equals $120. Now my total debits equal my total credits. Okay, so that wraps up Learning Unit 3. And just a reminder for when you do the homework, you must keep track of your treasury stock and how many you're purchasing for each price. And also remember that dividends are not paid on treasury stock, only the number of shares outstanding. And treasury stock is not considered outstanding.